Hi everyone, this is your daily 10-minute business and finance news wrap for this Monday, the 29th of March 2021. I'm Ricardo Gonçalves. Later, is the banking regulator responsible for taming house prices? But first, we'll go straight to the Australian share market where, despite starting in the black, the S&P ASX 200 finished in negative territory, down 0.36% to 6,799. Tech and travel stocks did the most damage. The likes of Flight Centre and Webjet declined as Queensland announced a 3-day snap lockdown of Brisbane amid a new COVID cluster. The major miners did well today, though. For more on today's market action, I spoke earlier with Julia Lee from Burman Invest. Julia, the market is down today. Why?
Ricardo, the Australian share market actually started off on a positive note. We were up 0.5% given the positive leads from the US. But talk of liquidation from a big hedge fund manager has sent shares lower, as well as the US futures. In fact, if we have a look across at Japan, we're seeing Nomura shares down by 15%. The brokerage company coming out to say that they are looking at a potential $2 billion loss related to a US client. So the market's speculating that it could be related to that liquidation. And of course, that's been bad news for shares. In particular, tech stocks are down heavily, although the miners are on positive ground today as iron ore prices rise 2.5% in China.
One interesting story from last week was the blocked Suez Canal and that tanker there. It seems like it's being refloated as we speak this afternoon. Any immediate reaction from the oil markets?
Well, the energy sector was one of the strongest areas on the Australian share market, but as news hit that big tanker had been refloated, we have seen energy companies coming under pressure. Woodside Petroleum at one stage was up by around about 2%. It's now down by about 0.2%. And of course, if we have a look at the Suez Canal, that's responsible for around about 9% of oil-related products per day. So obviously now with the tanker being refloated, it looks like the oil market is going to be refocused in on the lack of demand coming down from Europe because of the lockdowns.
Speaking of lockdown, Brisbane saying today the city will be in a 3-down snap lockdown because of a bit of a COVID cluster. Any impact on the market?
I mean, the timing of this is horrible. The last big lockdown that we saw impacted on that peak Christmas holiday season. And this particular lockdown comes just before the Easter school holidays. So you have to feel for the hospitality operators as well as anyone planning a holiday in Brisbane. Unfortunately, we are seeing those travel stocks once again being hit. We're seeing Flight Centre down, Webjet lower, Qantas all trading down lower on the back of this lockdown. And of course, all eyes are watching to see whether it will just be that 3-day lockdown which controls the breakout or whether we will see a wider effect into those crucial Easter holidays.
Exports also in focus. We heard about the Chinese tariffs on Australian wine over the weekend. What are the implications?
Well, Treasury Wine Estates is our largest listed wine company and the stock is trading down around about 2% in trade today. It does look like there will be a more permanent duty being imposed, 175.6%, starting from the 28th of March this year for 5 years. Of course, if we have a look at Treasury Wine Estates, its first half net profit was down, impacted heavily by its trade from China. And the second half is expected to be worse. So it does look like that this isn't a problem that will go away quickly for Treasury Wine Estates. And instead, the company is going to have to focus on trying to get that Chinese wine out to other regions.
We're seeing a bit more M&A activity today, merger and acquisition activity in the property and gaming sectors.
The gaming sector has been quite hot for merger and acquisition activity, whether it's Tabcorp or Crown or Foxbet looking to come into Australia. There are rumours that Foxbet could be looking at taking over some of Tabcorp in order to put its footprint down in Australia. But with interest rates still at a record low, it is expected that merger and acquisition activity is going to continue.
Yeah, to what extent do you think it is going to be a theme, this M&A activity throughout 2021?
I think, Ricardo, one side of the equation is that funding costs are just so low at the moment. When you're looking at 0.5% in terms of funding costs and the cost of equity being so low, it means that the return from that investment is potentially higher over time. So not only are infrastructure assets in focus, AMP's infrastructure assets, we've seen Cleanaway, Bingo also very much in focus, but we have seen quite a bit of activity in that gaming space as well. So I think it is going to continue as long as we see interest rates this low and, of course, funding so low.
Julia Lee there from Burman Invest. From the equity market, let's go to the housing market. And who is responsible for controlling house prices? Well, not the banking regulator APRA, which spoke at an economics committee in Canberra today, and it comes on a day where records continue to be broken, this time with Melbourne dwelling values now reaching new heights. CoreLogic says after a 6.1% decline through COVID, prices have now recovered those losses to be 13.8% above their mid-2019 lows. They're now 0.2% higher than their all-time highs. Earlier this month, Sydney home values reached record fresh levels. And last weekend was considered Super Saturday on the auction front, with 3,791 homes taken to auction across the combined capital cities during the week. This is according to CoreLogic, and that is the busiest auction week since March 2018. So soaring prices across the country has raised pressure on regulators to take action, but the Australian Prudential Regulatory Authority said solving house prices or affordability is not its job. Here is its chair, Wayne Byres, responding to committee chair Tim Wilson.
If the house prices continue to rise, young Australians find it harder to save a deposit more than ever, at least because 10% of their income is taken away from them, put into locked away for 50 years. But then in addition to that, you make it harder for people to access cash, credit, I should say more correctly, that what we'll actually see is a housing market which advances the interests of those who already own a home, but essentially lock out first home buyers.
Thank you, Chair. So I'll probably start just by clarifying the way you paraphrased what the Reserve Bank said, because I think the bank has been very clear, and we've certainly been very clear as well in saying our job is not to set or seek to target house prices. I've repeated that many times over the years when there's been debate about housing. It's not our job to solve house prices, not our job to solve affordability. What we have been watching, though, and as you would expect us to be watching, and our fellow regulators at the Council of Financial Regulators are watching, is the extent to which there's a dynamic emerging of increased risk-taking by the community and by the financial sector. At this stage, that's not evident.
Wayne Byres there, the APRA Chair, speaking at an economics committee earlier today. That is SBS On The Money for this Monday, the 29th of March 2021. I'm Ricardo Gonçalves. You can follow me on Twitter and on Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.